Chapter 3 examples. So in Chapter 3, we talk about the end of the accounting cycle when we need to use adjusting entries and closing entries to prepare our accounting records for the end of the period and get them ready for the beginning of the next period. So we have several items throughout the month that don't get recorded in a normal transaction. And these are the accounts that we need to perform adjusting entries for. So when we're looking at adjusting entries, we have a selection of adjusting entries over here. And we're going to look at preparing each one. So first we have wages are $5,000 every week for a 5-day work week and paid on Fridays. December 31st is on a Tuesday. So we're closing the year on December 31st, and we need to cover the salary that occurred in December. So that's part of our revenue recognition and matching principles under accounting US GAAP rules, are that we need to keep expenses in the period in which they incurred. So we can't just wait until January when we pay those expenses to record that expense. So we have to record the part of the expense that happens in December. So if we have a 5-day work week and a $5,000 salary expense, then for each of those 5 days, we have a $1,000 expense. If we're closing the books on a Tuesday, we need to record 2 days of accrued wages. So we would have wages expense, $2,000, and wages payable of $2,000. And then those wages payable would be paid in January. The second adjusting entry that we look at is depreciation expense. So depreciation is the use of our property, plant, and equipment over a period of time. So we record an expense against the useful life of our property, plant, and equipment. So we have equipment that is worth $24,080. That's its historical cost that it's recorded in our books following the historical cost principle. The equipment has a salvage value of $2,000. This means that when we dispose of this equipment, we believe we can sell it used for $2,000 and a useful life of 8 years. That means that our company plans to use it for 8 years before we dispose of it and get new equipment. So for straight line depreciation, we take the historic cost minus the salvage value and divide it by 8 years. So if we're looking at $24,080 minus $2,000 divided by 8 years, we have a yearly depreciation expense of $2,760. So if we're recording the depreciation expense for the entire year, it would be $2,760. If we want just 1 month of expense, we're going to take that $2,760 and divide it by 12. We record a depreciation expense, $230, and we save our depreciation expense in an account called accumulated depreciation. This is tied to our equipment account because it's for equipment. So we would have a separate depreciation account for each asset that we depreciate over a useful life. That accumulated depreciation account is called a contra asset account in that it reduces an asset account. And the next one we have supplies with a $240 debit balance at the beginning of the year. During the year, $5,200 worth of supplies were ordered, and a physical count of supplies at December 31st shows $440 worth of supplies. So what we're going to do is we're going to make a T account for supplies. And we're going to put in the information from that sentence. So we started the year, we had a beginning balance of $240. During the year, we purchased $5,200 worth of supplies. Now we looked in the supply closet and we calculate that what is left in there is valued at $440. So for our supplies account, we need to record a credit entry that reduces the amount in there from $5,440 so that the balance reflects what we have left in our closet. So we would have a $5,000 supplies expense. And we would credit our supplies account for $5,000. Transaction D. We prepaid insurance for 1 year on October 1st of $4,800. Record 1 month of insurance expense. So 4,800 divided by 12 is $400. 1 month of insurance expense is $400. We would record an insurance expense and reduce our prepaid insurance account to show that we have used up insurance. E, the company has incurred $1,200 interest expense for the year that will be paid on January 10th, 2021. So we have interest expense of $1,200 and interest payable that we're going to pay in the next month. Okay. F is the same, it's just on a different loan. So we have a bank loan with $2,500 interest due on January 15th. So we don't have to pay it until January 15th, but that expense occurred in December. So we have interest expense, $2,500, and interest payable of $2,500. And the last one is an unearned revenue adjustment. So we received payment of $3,600 for 6 months of services on December 1st. So we contracted to provide 6 months of services on December 1st, and we were prepaid. So we have an unearned revenue account with $3,600. So what we need to do is we need to recognize that now that it's December 31st, we have earned 1 month of that revenue. So we're going to reduce our unearned revenue account. And record 1 month of service revenue.